The Borrow Smart segment today being brought to you by the National Institute of Financial Education. We're out there just trying to educate our community one individual at a time. National Institute of Financial Education. Should you buy a house with a high mortgage rate? That is our subject today. Learning that mortgage rates have gone up can feel like a dagger in your homeownership dreams. Your mortgage rate affects your monthly mortgage payment, the total interest you pay, and how much house you can afford. So naturally, it's worth considering whether buying a house at a high interest rate, more specifically, financing a house at a higher interest rate, is a wise move. How a 5.7% APR compares to a 2.88 APR. If you purchase a $428,000 home, yes, I know you're talking the Inland Empire, but you can double these numbers if you want. With a 3.5% down payment at a fixed APR of 5.7 over 30 years, your mortgage payment would be $33.37 each month, including private mortgage insurance. Actually, that might even be the mortgage insurance premium. By comparison, financing at 2.88%, the median rate in mid-July 2021, would put your payment at $26.55. At 5.7, you'd pay a total of $449,961 in interest over the life of the loan. That's double what you'd pay if you financed at 2.88%, $204,000, and more than the cost of the home itself. What a higher mortgage rate means, increased costs, are the most obvious effect of higher mortgage rates, but that's not the only factor to consider. You may have to adjust your budget or your expectations or both. Most lenders expect your total debt payments below 36% of your monthly income, so you may have to shop for a lower priced home than you initially planned, or call us at 800-306-1990. We may have a different solution for you. Some lenders may stretch the debt-to-income ratio to 45% if your finances are strong, like you have a bigger down payment, low debt, and good income. You still may have to make some sacrifices. Spending more on your mortgage could affect your other financial goals, like saving for retirement. Since your mortgage rate is partly based on your FICO score, maintaining good credit could help you buy a home. Consider taking some time to improve your credit so you can qualify for a better rate. Moving into a higher credit tier could shave hundreds off your mortgage payment and save on interest. Hard to predict what will happen to home prices, but also note that falling home values, particularly in the early years of home ownership, could put you upside down in your loan. When you owe more than your home is worth, selling or refinancing is tough. Plus, you wouldn't have access to home equity regardless of how many payments you've made. Renting may be more favorable for now, do you think? Some people think of renting as throwing away money or paying the landlord's mortgage. It is, but it's not always that simple. Renting could make more sense financially when rent is lower than your would-be mortgage payment. If you continue renting, you can take advantage of the cost difference by putting the surplus aside each month. This preps you for a higher mortgage payment and creates a cushion for unexpected expenses. Even when the numbers line up, buying is more beneficial than renting, only if you stay in the home for a certain period of time. Selling too soon can wipe out your gains. Lower the cost of a high note. Every home buyer's situation is different, so you have to weigh the costs and benefits to determine what's best for you. If you run the numbers and decide to move forward with your purchase, you have a few options to soften the impact. Number one, make a bigger down payment because you're borrowing less. You'll pay less interest over the life of the loan. Opt for a shorter term. Don't do that. Paying your loan back sooner lowers the interest you pay, but you'll have a much higher monthly payment. Buy down your interest rate. The lump sum payment can lower your interest rate and monthly payment, but only to a certain limit. Ask your lender about no-cost loan options. This won't lower your rate or payment, but will lower the overall cost of buying a home. Keep your finances strong. If you're locked into a high APR and rates drop, financing is an option, if it makes financial sense, of course. As always, get your FICO scores, know what they are, from myfico.com, myfico.com. Shorten the term. I want to just go and touch on that one just a little bit further. The idea of shortening the term on your loan is not a good idea. The idea of shortening your term by just increasing your payments is a good idea. You're dealing with you're dealing with the amortization table when you're doing it that way. And I like the idea of dealing with the amortization table just because that helps you in the long run. You can make a larger payment, you're getting more equity. Those are all good things. The thing that bothers me is when people go and get tied into those other loans, the shorter term loan, and you have uncertainty, because what happens if you can't make that larger payment? You're still on the hook for it. That's not a good idea. So pay it early, that's fine. Also remember that if interest rates go down, now don't look at the interest rate, the APR you got 2 years ago. What was the interest rate you got 2 years ago? They may not be the same. They're generally not the same. And if you're looking at the APR now, that may not be the wise idea. Look at the interest rate versus the interest rate, and then look at costs and what's the break-even point. The break-even point is not the time just dividing the payment by the cost, because part of that payment is just going into your savings. It's the interest saved divided by cost is what you really want to be looking at. So that's the Borrow Smart segment, brought to you by the National Institute of Financial Education.